Hello and welcome again to my channel. I'm David, a financial analyst for over 28 years. Today I will explain what is the COT and how to use it. One of the most important aspects concerning commodities is to know how the positions held by financial institutions, those who speculate in the market, and operators, those who work with a commodity and access the market for hedging purposes, are divided. This is made possible by the Commodity Futures Trading Commission, CFTC, which every week, usually Friday, releases a report, the Commitments of Traders, COT. The report shows market data for the previous Tuesday, so it's slightly delayed. But this is not a big problem. The report shows each commodity and the long and short positions held by each market participant, as shown below. Producer, merchant, processor, user, an entity that predominantly engages in the production, processing, packing, or handling of a physical commodity. They use the futures markets to manage or hedge risks associated with those activities. Swap dealer, an entity that deals primarily in swaps for a commodity, also use the futures markets to manage or hedge the risk associated with those swaps transactions. The swap dealer's counterparties may be speculative traders, like hedge funds, or traditional commercial clients that are managing risk arising from their dealings in the physical commodity. Money manager, for the purpose of this report, is a registered commodity trading advisor (CTA), a registered commodity pool operator (CPO), or an unregistered fund identified by CFTC. These traders are engaged in managing and conducting organized futures trading on behalf of clients. Other reportable, every other reportable trader that is not placed into one of the other three above categories. In the figure, you can see the wheat COT taken on the 7th of March 2023 and relating to the 4th of March 2023 for futures only in the short format. The CFTC also releases a long format and a version where it aggregates futures positions with options positions. All entities in the COT, therefore, are required to report their positions if they exceed a certain number of contracts, called the reporting level, and that you can see in the figure. The reporting level is set by the CFTC and is updated over time. Small traders and investors don't have to declare their positions, as they are very unlikely to exceed these levels. Now the breakdown of subjects that you have seen is what is known as disaggregated. There is also a version that aggregates the four subjects into just two as follows: commercial equals producer, merchant, processor, user, plus swap dealer. Non-commercial or large traders equals money manager, plus other reportable. Commercial are the real experts. They know the real value, price, of raw materials, the actual supply and demand, and any problems. They move against the trend, buying on the lows and selling on the highs. Non-commercial or large traders, banks, hedge funds, commodity trading advisors, etc. Trend followers who use futures as speculative instruments for pure profit. Non-reportable positions. Small speculators who don't hold a position large enough to be reported to the CFTC. They tend to follow the non-commercial. Here, you can see the same corn COT taken on the 7th of April 2023, but in the legacy, aggregate version. Let us now see how to read and use the COT. Regardless of the type of report used, the number of long and short contracts is shown for each category. In this way, you can immediately see whether operators tend to be bullish or bearish. Spreading and spreads report the number of the contracts held in spread. That is, those positions balanced created with the purchase of a futures contract of a commodity and the contemporary sale of another futures contract on the same commodity, but with different delivery, expiration. Therefore, it's easy to realize that the figure only reports intramarket spreads. For those not familiar with spread trading, An intramarket spread is created by buying and selling futures contracts of the same commodity, but with different deliveries. Changes from shows the change from the previous week's report. Percent of open interest represented by FOR. Each category of trader reports the percentage of open interest held by each category. The number of traders in each category shows the number of traders in each category. A point of clarification is in order. As also reported by the CFTC, the number of traders in each category generally exceeds the actual number of traders in each category, since spread traders may also be present in long and short positions. As it stands, this information tells us little. It doesn't allow us to understand the real behavior of the various market players. What you need to do is to put the data on a chart and compare it with the price chart. Fortunately, you don't have to do this yourself. There are sites and software that offer these charts for free. Personally, I use the Spread Charts app, which, apart from being free, I think is the best for analyzing a spread. However, you are free to use another software. Okay, this is all interesting, but how do I use this information in my trading? Mistakenly from what people think, the COT is not something that gives signals to buy or sell, but only gives indications of the sentiment of the main market players, often anticipating trend reversals. Therefore, the COT must be interpreted and evaluated together with price trends and other important data. Another important aspect from my experience is that COT is not of the same importance for all commodities. I only use it for grains and softs. I also take a look at copper, but for the other commodities, I tend to ignore it. You can get a confirmation about this by looking at the COT of gold or natural gas. So the COT is another string to your bow, one more aspect to add to your analysis, but don't treat it as the holy grail. You need to evaluate it along with open interest and compare it to price movements. To conclude, let me show you a couple of ways in which the COT gives me likely trend reversals. Excessive buying-selling. There are levels of the net position beyond which we have an excess of long or short positions. Excesses can continue for several months, so the fact that the net position is above or below certain levels tells us nothing other than that the underlying is heavily bought or sold. Only a return to more normal levels provides a signal of a probable reversal of the trend. For the sake of clarity, I will show you an example with the chart of the last 20 years of sugar. At the top is the COT with the net position of the speculators, and at the bottom is the continuous chart. First, the net position is the long contracts minus the short ones. Then, as you can see, I have drawn two horizontal lines, one blue support, minus 120k, and one red resistance, 170k. Occasionally the net position falls below support or rises above resistance, which means that the speculators are strongly bearish or bullish. In these situations, it's not at all advisable to open positions trying to find a level where the trend can reverse. The probability to go against a strong loss is elevated. Instead, you should wait until the net position rises to at least minus 100k after falling below the blue line, or falls to at least 150k after rising above the red line, before opening a trade. Divergences. Another aspect that gives me a wake-up call is the divergence between price and net position. It means that the strong hands are losing interest and that a trend reversal is very likely to occur. A current example can be seen on the orange juice chart. The price of orange juice has been rising since 2022, and initially, the rise is accompanied by an increase in the speculator's net position. But since the end of January, the net position has started to decline. However, it's very difficult to tell when the trend started to reverse. In these cases, it's not possible to set rules. Most of the time it's experience and knowledge of the commodity and the general market situation that counts. This is how to use and interpret the commitments of traders COT. Probably some of you will have been disappointed, expecting something different, easier to use with clear signals. Unfortunately, this is not the case. The COT is an important piece of data, but it has to be evaluated, construed, and then put into a bigger context, that of the analysis you are doing. Thank you for watching this video. I hope what you have learned today will help you in your trading. Let me know what you think about it in the comments down below, and if you are interested in other educational videos on the world of trading and financial markets, remember to subscribe to my YouTube channel. This way, you will be updated with all my newest videos.